This is Amit Pabari, founder and managing director of CR Forex. The most important event of the week is RBI monetary policy, and RBI make decision based on several factors. Let us understand the key major factor based on which they are going to take a decision whether to increase the interest rate, decrease the interest rate, or keep it neutral. So the first important aspect to make a decision is inflation, which is called महंगाई. RBI का target range for inflation is between 2 to 6%. April में जो inflation आया था that came at 4.1%, which is lowest since October 2021. So basically we can say that inflation is under control, because of which RBI may not increase the interest rate in this monetary policy. Just like last monetary policy, they will look at the market and may not decide to increase the interest rate. The second important factor which RBI considers before making a decision on the monetary policy is growth. Now the growth for GDP growth for FY23 came at 7.1%. In the March quarter, the GDP grew at 6.1% versus 4.5% in December 22. Basically, it indicates that growth is intact. So RBI will not be in a hurry to decrease the interest rate in the current monetary policy. Now let us understand what is the impact of monetary policy on rupee. The first kind of scenario is RBI will not go and do a rate hike. The probability of that is close to 80 to 85%. If that happens, then rupee will be in a range between 80 to 20 on the lower side and 80 to 60 on the higher side. The second kind of scenario is where RBI will go and decrease the interest rate. If that happens, then the interest rate difference between India and US decreases, because of which we will see an outflow from Indian bond market towards developed market. If that happens, then we will see that rupee will get weaker towards 80 to 83 kind of levels. Now let us discuss the outlook for rupee. In our last week video, we discussed that the pair has entered into a consolidation phase between 82.20 to 82.85 kind of a level, and there's a 70 to 80% probability that the pair will move towards 80 to 40 and 80 to 20 kind of a level, and exactly the same has happened. Now let us see what is the outlook for the coming week. For the next week, we expect the pair to remain in a consolidation phase between 80 to 20 on the lower side. If that level comes, then ideally importers should buy, and on the higher side 80 to 60 to 80 to 75 will act as strong resistance for the pair. If that level comes, exporters should participate to increase their hedge ratio. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporter. In last week video, we discussed that ideal strategy for thin margin exporter is that they should cover 100% on a back-to-back basis between 80 to 60 to 80 to 80 kind of a level. Now for this week also, the strategy remains the same, that they have to cover on a back-to-back basis because 80 to 85 will act as a strong resistance. For covering, they can target levels between 80 to 60 to 80 to 75 kind of a level. If anyone is waiting, they should keep a strict stop loss of 80 to 20 or costing whichever is higher. Now let us discuss strategy for thick margin exporters like textile exporter or engineering exporter. When the pair is moving in a consolidation phase, the ideal strategy for thick margin exporter is that they should be able to churn their portfolio. What does churning of portfolio mean? It means that they should book forward at higher level, and when the pair appreciate at that point of time, they should pre-utilize their forward contract. Now if you have been listening to our videos, then when the pair was trading close to 81-80 levels, we suggested thick margin exporters that they should ideally pre-utilize their forward contract, and when the pair reached towards 80 to 80 kind of a level, we suggested them to book forwards. Now if anyone has missed booking forward, they can target level close to 80 to 60 to 82.75 kind of a level. Ideal hedge ratio, if someone is booking under anticipation order, is they should not exceed beyond 50%. Now let us discuss strategy for importers. From last 2 weeks, we have suggested importers that those who have missed covering June imports, at lower levels between 81.80 to 82 kind of a level. Ideally, you should keep a stop loss of 82.85 and wait, as you are expecting the pair to appreciate towards 82.40 to 82.20 kind of a level. Now, for the coming week, importers should target to cover their near-term imports for next 20 to 25 days between 82.30 to 82.40 kind of a level, and ideal stop loss for them still remains 82.85. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.